Okay, looks like we are live. We'd like to welcome everybody to the March 2026 market update. Um, as we click on the disclaimer page, give you a little background. Uh, GHP Investment Advisors is a registered investment advisor and fiduciary based out of Denver, Colorado. We manage just over 3 billion of AUM. Just a side note, we are celebrating our 30th anniversary. So thanks for 30 years of your trust with GHPIA. By way of introduction, I am Brad Engle, the Director of Research Trading and Portfolio Analytics. And with me, as always, is Christian Lewton, our Chief Investment Analyst. Few housekeeping items. We will talk about some things we're seeing and kind of monitoring in the current market environment. Christian and I will give around a 30-minute presentation, and we will take questions at the end. So to submit questions, go to the bottom of the screen, and you will see a Q&A button. You can click on that, type in a question, and we will try to get to all of them by the end. So let's go ahead and jump right in. So AI is still dominating headlines. As we talked about in many of our past webinars, the story still dominates headlines and it will continue. But we specifically want to touch on AI spending. Here we are looking at capital expenditures, or CapEx. CapEx is what companies spend on things like property, real estate, equipment, technological infrastructure, software, etc. We feel this chart puts the AI spending story in perspective. What you're looking at is CapEx broken out between the 5 hyperscalers and the remaining 495 companies in the S&P 500. Hyperscalers, if you don't know, are very large cloud computing companies that operate massive data centers and provide things like computing power, storage, and services on a global scale. They're basically the backbone to the AI growth. In the previous year, the hyperscalers, and specifically Microsoft, Amazon, Alphabet, Meta, and Oracle, combined to spend around 412 billion. That number is obviously staggering. But look at what's projected for this year. Nearly 670 billion just out of these 5 companies. That's a 62% increase in CapEx from just a handful of names. And it's not slowing down, to be honest. To put it in perspective, that's just over 2% of US GDP, or gross domestic product. So the gray bar is the remaining 495 S&P 500 companies. This spending goes from 755 billion last year to an estimated 713 billion this year. So essentially flat to slightly down. What this tells us is that AI infrastructure spending is becoming increasingly concentrated. 5 companies are making a generational bet on this build out that we're seeing. And this build out includes data centers, chips, power infrastructure, basically the works when it comes to AI. The scale is unlike anything we've seen in a normal CapEx cycle. So the key question for investors is whether this spending ultimately translates into returns, or whether we are in the early stages of an infrastructure overbuild. For now, the commitment from these companies shows basically no sign of slowing in our eyes. So to further put this into perspective, let's look at CapEx spending as a percentage of operating cash flow, which is what you're seeing here. This chart takes the spending story a step further. It shows CapEx not just in raw dollars, but as a percentage of operating cash flow. And so what is operating cash flow? Operating cash flow is essentially the cash a business generates from its day-to-day operations. But that's before investing in financing activities. So it's a great measure of a company's financial health. When you look at the CapEx as a percentage of that number in the chart, you get a real sense of how much of companies' financial power is being consumed, or how much of these company financial power is being consumed by investment spending, basically. What the chart shows is that For most of these hyperscalers, that percentage is now approaching or in some cases exceeding 100% of operating cash flow. So if you look at the right side of the chart here, and I don't know, Christian, if you want to use the pointer, you're more than welcome to. Three of those five are above the 100%. That means some of these companies are spending much more on capital investment as they're generating an operating cash flow. Oracle is an extreme example. If you look at the very right side of the chart, that green line that spikes up, they're projected to be nearly 190% by 2026, meaning they will have to continue to use debt to basically fund this build out. Oracle was a little late to the spending party. That was kind of the reason for this dramatic increase. They were not going in as heavy on AI, but realized they were falling behind. So that's why this large increase from Oracle shows on the right side. But not all CapEx is the same. So if you look at Amazon, which is the gold line on the chart, it has slightly higher spending overall from a CapEx or CapEx as a percentage of operating cash flow. And that's due to its retail business. The spike in the COVID years, as you can see in the middle of the chart, kind of from 2020 to 2023, was due to high e-commerce demand that appeared. Obviously, when we were all stuck at home, we wanted to order everything we could from Amazon. So they had to spend heavily in new fulfillment centers, basically to keep pace. So that was the reason for their initial spike. But as you can see, their growth has continued in CapEx spending as a percentage of operating cash flow towards the right side of the chart. This current trend is a big part of why we have seen these hyperscaler stocks pull back recently in recent months. So since October, Microsoft is down around 21%. Amazon is down around 5%. Meta is down around 15%. Oracle is actually down 45%, around 45%, and that's actually better than it was. They were down over 50% at one point. And Google or Alphabet, old habits die hard, is actually up 26%. And this has more to do with the large pullback Google saw earlier than these other companies did. Many thought their search engine was going to become obsolete because of the chatbots and basically found that search would be unnecessary. We'd no longer have to go to Google and click on link after link to figure the data we needed. We could just use these large language models or chatbots to answer questions. But it turns out Google search continued to grow, and paired with their chatbot, Gemini, I'm not sure who uses ChatGPT or Gemini, they continued to gain market share. So the market basically isn't questioning whether AI is real. It's questioning the return on investment. When you're spending at this scale, the cash that's going into data centers and infrastructure is cash that could otherwise be returned to shareholders through things like share buybacks, dividends, or even used to strengthen the balance sheets of these companies. So investors are essentially asking, when does this spending start paying off? And until these companies can clearly demonstrate that the ROI or return on investment justifies this outlay, that uncertainty is likely to remain a headwind for this group. But this leads to the questions, can earnings for these hyperscalers keep up?
Yeah, so I think as Brad pointed out, the scale, just the sheer size of this AI infrastructure spending is truly remarkable. And the ROI concerns that we are seeing being priced into the market as of late are very real. So I think the natural follow-up question to that would be, are we witnessing another bubble in regards to AI? So we think this chart that we're showing here right now is one of the key reasons why we would actually push back on that type of characterization. So here we're looking at those same five companies. So again, this is going to be Microsoft, Amazon, Alphabet, Meta, and Oracle. This is what they actually produce in net income or real profits. So we can see just a couple years ago, net income was around $347 billion. Over the past 12 months, net income grew to $416 billion. And then consensus expectations are for profits to reach $472 billion over the next 12 months. So these are not just startup companies burning through cash and promising future profits, 10 years from now. These are actually some of the most profitable companies that we've ever seen. And what makes this story even more unique and remarkable, and I think a lot of people are kind of forgetting today, is the vast majority, if not all of these profits we're seeing are from their core businesses. So think the cloud infrastructure, that's like the Microsoft Azure or Amazon AWS, the digital advertising, so obviously Google search, and Facebook, and then the enterprise software, so Microsoft Office 365, and then Amazon's e-commerce business. The whole AI story that we're seeing, we're very much in the early innings of the actual monetization of that. So this is definitely the fundamental distinction if we compare today to something like the dot-com bubble. So back then, companies that were driving the market, a lot of them had little to no revenue, let alone profits. And today, and the valuations back then were actually built entirely on narrative and kind of the potential of what the internet could do. So what we have today is more of the opposite. This whole AI investment thesis that we're seeing is really being funded by businesses with very real and growing earnings power. Sure, we are skeptical that every dollar of the AI spending that we are seeing is going to generate a meaningful or immediate return. However, even when you strip away the AI noise that we're seeing, these are exceptional businesses with enormous economic moats. And I think the case gets even more compelling when we look at what's happened to valuations over the past year. So here we are actually showing the forward price to earnings ratio for these hyperscalers, as well as the S&P 500, which you can see the S&P is going to be the light blue line here. So as you can see, since the start of 2025, valuations have actually been coming down. Every company, in fact, except for Google, which Brad kind of just gave the story of what happened to Google, every company has seen multiple compression over the past 15 months. And currently, they're all trading under our large cap growth benchmark of 27 times earnings, and actually very close to the broader S&P 500 multiple of around, today it's around 21 times. And this is notable because a lot of these companies are actually growing earnings nearly twice the rate of the overall market or the S&P 500. Historically, bubbles do not behave this way. Again, thinking about the dot-com era, the NASDAQ PE that moved in one direction, which was higher. The PE ratio peaked around 60 times forward earnings, maybe a little over 60 times forward earnings back then. And what we're seeing here today is actually the opposite. So as this AI excitement has grown and these companies have continued to deliver strong quarterly results, we continue to see improving margins, improving profitability. And we also see, like this chart shows, the valuations have continued to moderate. So today, the market is actually being very disciplined. And what we're seeing is, in my opinion, the market acting very rational, and trying to decipher what comes next in terms of the AI story.
So some of the news lately, especially when it comes to bubble talk, is the SaaS apocalypse, which is actually harder to say than you think. But SaaS software is one of the most debated parts of the market right now. And SaaS accelerated alongside cloud computing in the early 2010s. Basically, instead of buying software outright, companies subscribed or logged in over the internet. So if you had a business or worked at a company who had software that sat out on the internet instead of being internally on your server, that is basically SaaS-based companies. That's software as a service. So for these sellers and developers of the software, it was a dream business. You had massive reoccurring predictable revenue. You had growth was typically, or gross margins were typically north of 80%. And once you built that software and put it out, adding a new customer costs very little. And that's why investors bid these valuations up so aggressively. Now let's look at what happened. If you look at the chart on the left, the IGV, which is a broad ETF tracking this space, is down roughly 30% from the October 2025 high. So if you look at the blue line in the left chart, you can see that dip at the very right side of that chart. That was basically the SaaS apocalypse that was people were talking about. And yes, you could guess the culprit was AI. Tools from companies like Anthropic and OpenAI can now replicate certain software functions and what they call vibe coding, where anyone can build custom tools just by describing what they want in plain language, which is huge. This raised questions. Do companies still need to pay for outside software subscriptions like these software companies provide? Obviously, why the stocks sold off. The fear for SaaS companies is that growth slows and margins compress at the same time. And because these stocks carry premium valuations, so if you look at the chart on the right, we're looking at the price to earnings ratio, which is a valuation ratio. So when you're reading typical news articles, things like that, or you hear people talking about the valuation of this company, they're typically referring to the price to earnings ratio. And you can see in this chart that IGV averaged around 36 times earnings from 2020 to 2025. The multiple compression has obviously been swift. Today, IGV trades for around 20 times earnings. So if you look at the very right of that the gold line, it's come down substantially. So our view is that the sell-off has been over-exaggerated. Many established platforms have the scale, they have customer relationships, they have proprietary software and proprietary data and models that sit behind a paywall. So they're not easily accessible by these large language models like the ChatGPT and Grok and Claude and all that. The market is basically telling this sector that the party's over, but we believe it is creating opportunity. Although some companies will be more heavily impacted by this, but we believe, as many companies have expressed, as Christian and I listen to a lot of what the companies have to say, they're going to use AI and build it into their software, which they're already doing and have already started to release, which this should help to create increase efficiencies and demand for these software companies. So we continue to look for opportunities in the sector and hopefully get it at a nice bargain with these valuations coming down. But this plays into our next topic. Will AI cause massive job loss? And so the labor market has obviously been a hot topic due to AI. And funny enough, Christian and I just got back, or we recently attended a NABE conference. It's a NABE policy conference in Washington, D.C. And NABE is the National Association of Business Economists. And at this conference, economists from all over the world and world-renowned economists gather, and you have policymakers come to the same place, and they talk a lot about things that are happening in the market. And while we were there, Dr. Chris Waller, who's on the board of governors for the Fed, he gave a talk, and he basically said the job market is worse than we thought. Well, then Austin Goolsbee, who's the Chicago Fed president, basically in his talk said the job market is steady and fine. So you have two people working for the Fed that have different views on what the labor market is truly like right now. And to be honest with you, in a room full of economists, not a lot of people had an idea of how AI was going to affect the labor market because there's not a lot of data out yet. But if we look at the chart on the left, we're looking at non-farm payrolls, which show monthly jobs added to the US economy. But this chart is showing it on a 3-month rolling average. And in that chart, if you average it out, we've averaged just around 27,000 jobs over the past year. So on a 3-month rolling average, 27,000 jobs a month. That's compared to the long run average of roughly 89,000 going back to 2000. That's a significant slowdown. Part of this is the natural cool down from the post-pandemic hiring frenzy we saw in 2021 and 2022. So if you look at the chart on the left, you see that dramatic dip around 2020 and then that dramatic spike. Obviously, that was when COVID hit and there was quite a few layoffs, and then the hiring came back fairly quickly. But that chart continued to stay elevated after that because there were a lot of people that left the job market, decided to just outright retire and take early retirements from some organizations. So the hiring frenzy had to continue for a period of time. But we think something more structural is also at play. Basically, companies across the economy, not just the mega cap stocks that we've been talking about, are pausing on headcount as they figure out what AI means for their workforce in particular. Many are investing heavily in AI infrastructure right now, and the capital is going into technology and not going into people. Essentially, businesses are in a wait and see mode, holding off on hiring until they better understand what AI can do for them. Makes sense. Now, what's important and what the right chart shows is that the slowdown in hiring is not being accompanied by a spike in layoffs. Layoffs as a percentage of non-farm employment remain historically low, hovering around 1.1 to 1.2%. So if you look at this gold line on the right, you see that large spike in layoffs during COVID, and then you see the dip, and that dip obviously makes sense because people are trying to find anybody they can. And then if that's the case, they're going to retain their employees. Well, even though we have seen an uptick, and in the news you might hear labor markets are going crazy, it's still trending up, but it's still well below historical average if you go back to the early 2000s. So while companies aren't adding jobs aggressively, they're also not cutting jobs. We would consider this a Goldilocks labor market. It's not too hot, it's not too cold. I mean, job creation has cooled, but the labor market remains intact in our eyes. We feel we are in the early innings of a long game, and this hiring has and this hiring hesitation isn't as worrisome yet. We are looking to see if it turns into something more severe and whether AI productivity gains maybe even start showing up in a way that reignites labor growth. The good news is the labor market is consistently evolving, which Christian will elaborate on.
Yeah, let me get the laser pointer here. So this is definitely one of my favorite charts when it comes to the labor market today. And I think it definitely helps put this whole AI disruption narrative into proper context. So what we're looking at here is the total US labor force broken out by industry. And I know it's a busy chart, so I'm going to walk through it slowly. So looking at the white line here first. So this is total non-farm employment in the US. So we can see that it has grown from around 52 million jobs in 1956 to over around 158, just over 158 million today. And if we just take a second to think about everything that's happened over this time period, for example, the personal computer that arrived late 1970s, early 1980s. Then we had the internet come along in the mid 1990s. That was the start of what we call the information age. Then you have e-commerce, which upended a lot of brick and mortar retail stores. Next, you had the smartphones and cloud computing. That was kind of the late 20 or early 2010s. Every single moment of these felt like a crisis, especially for people in those particular industries. Yet through all of it, we can see here by the white line that total US employment continued to grow. So I think this is the critical lens through to which to view AI today. I think the concern is legitimate, and obviously we're going to continue to read about in some of these doomsday stories. But at the same time, looking back at history, this is not new. And I think taking a step further, we can look at how industry composition has kind of shifted over time, because I think this does help tell the story as well. So in 1956 here, we see that manufacturing was around 30% of all non-farm employment. So 30% of around 52 million people back then. It's around 16 million jobs. Today, we see that that's only 8%. So these jobs were gradually, which you can see, displaced. Think globalization and moving factories overseas. Think robots and factory automation. The good news is all of these jobs were replaced. And we can see that a lot of industries that benefited were obviously more service related. So education and health services, that grew from 5% of the total workforce to 17% today. Professional and business services went from 7% to 14% today. And then there's other areas like leisure and hospitality, which went from around 5-6% to 11%. So I think the lesson here is pretty simple, and that the mix has changed, and it constantly has changed over time, but the total number of jobs created in the US continues to go higher. So I think again, I mentioned this, there's plenty of doomsdayers out there that are saying, AI is going to push unemployment to 10 to 20% over the next few years. But I think when you look at this chart, every single time we've seen one of these big technological shifts, the economy has adapted. New jobs showed up. Nobody knew what they were called. Nobody saw them coming. And we think that's the far more likely outcome here too. And these two charts kind of take this story even a step further. So at first glance, the chart on the left looks pretty alarming. So we can see here, this is labor share of gross domestic product in the US. So really this just measures how much of a country's total economic output ends up in the hands of workers, think wages or salaries. So we can see that's fallen from around 66% in 1947, so just after the World War II. We're all the way down at 54% today. So obviously somewhat concerning. And when I see this chart, the first thing I think about is some like factory automation. So a technological advancement, this has allowed companies to produce more output with less labor cost or wages paid to workers. So in reality, what's happening is workers they're getting a smaller slice of the overall pie. We see that happening in corporate margins, and that's real, and it's definitely worth acknowledging. But the chart on the right kind of tells the rest of the story. So despite that shrinking share, the typical American family earns nearly 2.5 times more in real inflation-adjusted dollars than they did in the 1950s. So what really kind of happened, and what this chart is showing, is that the overall pie gets so much bigger that workers took home even more, even as their slice got relatively smaller. So the message for today's AI anxiety is the same. It's labor share of GDP probably will continue to face pressure, and I think that trend is real and worth watching. But that metric alone does not determine whether people or Americans are better off. So by nearly every measurable standard, when we look at real wages or just quality of life in America continues to improve. So I think despite what people are saying, what we're reading out there is that technology is the enemy of all workers. Historically, it's actually been a great ally, and we have no reason to believe AI will be any different. All right, so to wrap up here, we're actually going to flip topics here. We're actually going to touch a little bit on the Iran conflict. And again, from a pure market standpoint, this has really been more of an oil story. And more specifically, it's been about the Strait of Hormuz, which is that critical bottleneck waterway. It's just south of Iran. And the reason why is that 20 million barrels of oil flow through it every single day. So 20 million barrels is around 20% of global demand. Global demand is just over 100 million barrels a day. So what we're seeing right now is that some of these neighboring countries, like Iraq would be an example. Iraq is the second largest OPEC producer. They produce around 4 million barrels a day. So they basically ship everything through this strait. And with that route currently cut off, they're being forced to move oil into storage. And as of late, storage has filled up. So they really have no choice but to shut in some of their wells. And unfortunately, turning on some of these wells, you can't just like flip a switch and it just starts producing again. So it's going to take time. So even if tensions do ease in the next day or two, week, let's hope, this supply shock that we're seeing is likely to linger a little further. I think I recently read that just maybe yesterday that Iraq, they're pumping around 1.2 million barrels a day. Again, I just mentioned their total typically around 4 million barrels. And then I also read Saudi Arabia has cut output by about 20%. So they're producing around 8 million barrels per day right now. So from all this, what we've really seen is a pretty meaningful spike here in crude prices. So you can see here in the chart, they've gone from around $60 a barrel to just over, it's kind of hovering around 100 as of today. But like we like to do, you can see that this chart, we took it back to the 1970. We like to take the 40,000 foot view. And this is interesting because we actually did this during our 2022 economic forum as well. So this is right after Russia invaded Ukraine, which would be right here on this chart. So you can see if we go all the way back in time, we can actually see that this move that we've seen recently, and it's pretty modest in the grand scheme of things, especially when we talk about percent moves. So the 1970s, for example, oil went from around it was just over 330 a barrel to $37 by 1979. So a tenfold increase throughout that decade. So this is genuinely economy altering. So what we're seeing today is not nearly of that scale. But we are starting to see some of this increase in oil price starting to flow into some near-term inflation expectations. And I think that's spilled over somewhat into some of the longer-term interest rate. Like the 10-year Treasury today is around 4.25, but that's been pretty range bound between 4 and 4.25%. But the good news is when we do look at oil futures, where oil futures are trading, the market is actually already pricing in a decrease in oil prices by the year end 2026. So the December contract as of this morning was around $76. So the market is telling us that let's hope even that this is likely a temporary, not a permanent structural shift where we're going to be seeing $100 or $150 oil for years to come. That said, we do expect volatility to continue as this situation evolves. And of course, as the market adjusts to new information in real time.
Um, so that kind of concludes what we've been looking at. We've been looking at all sorts of things. These are just things we wanted to touch on today. Before we get to questions, by the way, those of you that were late to join, if you want to ask a question, click on the Q&A button at the bottom of the screen and type it in, and we'll try and get to it. We do have an upcoming event before we close and get to questions. It's at the Inverness Hotel, Wednesday, April 8th. What's his name? Philip Kuntz. He's a former Navy SEAL. He served 6 years. He's a combat veteran. He was part of an elite special operations, including SEAL Team 10. He's an author, and he gives talks on teamwork and SEAL training and how, it helps navigate, business and life and things like that. So look for an invite. It might be in your spam folder in your email. If not, you can go to our website and register, but it should be a great event and a great speak. I've heard good things. So please come out and see us in person. Christian, if you want to click on the next one. So this is Christian and my contact information. Shoot us an email. We love to have conversations about these things. If you have, a thought or an idea or something comes up later, reach out. We'd love to hear from you as well. As of right now, I don't have any questions in the question queue, so I'm hoping it's working properly. But Christian, you want me to start with a question for you? Really hard one. What are your thoughts, or what are our thoughts on gold right now?
Yeah. So, I mean, our view hasn't changed. And we put out I believe it was second quarter 2025. I
Yeah.
could be wrong on the exact time, but
Yeah.
basically the run up that we have seen in gold, we think it's largely due to central bank buying. And our view really has not changed since then. It's actually interesting that we have seen gold pull back in the last couple weeks. With everything going on in the Middle East, gold's typically kind of that flight to safety sometimes when you see some of these geopolitical tensions. But I think this kind of meteoric rise we've seen over the last 2 years probably has something to do with that. But our stance really hasn't changed. We don't see any fundamental value in gold. Holding it doesn't have cash flow. You go to the local grocery store and try to buy something with a bar of gold. You can't do it. And we think it's largely some of the central bank buying that we're seeing.
Yeah, agreed. I still have no questions, so I'm hoping this thing works, or we just did an amazing job. I'll give it a minute. Does anybody have any questions, anything that they want us to elaborate on? Please throw it into the... Oh, hold on. Here's a question. Yes, I do see the test question. So it is working. We had a crypto. You want this one? You want me to take it? Yeah, I'll talk to it a little. So crypto, obviously, it comes and goes and it's pulled back. We still don't believe in crypto. We think it's the same. It's not exactly the same as gold. You can't go buy a loaf of bread at a grocery store with any cryptocurrency. It's a made-up currency. Even gold, you could do something with it. Crypto in our eyes is strictly a made-up currency that has no cash flow. It's a speculative investment. Sure, the price will ebb and flow with the market. They've said it's a hedge to inflation. Don't really see it that way. A hedge to the market. Don't really see it that way. It kind of moves in lockstep. So for us, it's the same story. There's no cash flow behind it. You have no earnings that you can discount. You have nothing to really go off of except the speculative value of it. So we still are holding strong on our stance. It just doesn't make sense to us at this time. Somebody has a follow-up. As a follow-up to gold, Christian, if you want to touch on more, what drives the central
Yeah.
banks buying?
Yeah, the question as a follow-up to gold, what drives the central bank buying? So again, I think we would have put this in our report, so please go see there for a more detailed answer potentially. But so for example, back in 2022, the Russia invasion of Ukraine, the US, we sanctioned and we froze around, I think it was $350 billion of Russia's US dollar reserves. So the reason why some of these, I'll call them bad actor central banks are buying gold is that the US is going to be a lot harder to freeze gold versus you can actually, through the SWIFT banking system, we can actually go and say you cannot use the 300 billion in reserves, the US dollars. So that's kind of it's really more about I'll call them bad actor type central banks going out, and they're really just trying to avoid some of the sanctions that the US has been putting on over the last few years.
Yeah. We have a question. Could you talk about poly markets? I'm not sure if everybody is familiar with poly markets right now, but it's basically a prediction market with prices equal probability. It's not gambling in a traditional sense. It's closer to kind of a real-time information market. Yeah, I don't know about you, but I have YouTube TV, and it seems like every other commercial that comes on is Kalshi, which is a poly market app. We've since messed with it ourselves. It's basically you're betting on things that you potentially wouldn't see on normal gambling sites like what are some of the gambling sites, Christian, DraftKings, things of that nature. And you're betting that something's going to happen as opposed you could take either side of the bet. And I think for us, we could see it becoming a very large market where you can bet on anything like, when is the Iranian war, the Iran war going to end? When is the ECB going to cut rates again? Things of that nature. It could be a big market, but as of right now, we're kind of sitting on the sideline trying to gather information. And I also think that from a policy standpoint, there's not a lot of regulation on it yet. And until, there's more regulation and they determine if it truly is a gambling site, what it is, things might change dramatically. But there's also from experiences we've had, you have a bet you place, but there is fine print that says, unlike you bet on a basketball game like March Madness that's going on right now, there is a winner and a loser and you have odds. Well, sometimes there's fine print. So if you do decide to mess with it, look and see because it might not pay out if certain expectations aren't met. So still a gray area for us, but we are evaluating.
I see here one. Talk about the price of oil on the market. I kind of hit on this a little bit. I think maybe that just to expand a little bit, if the higher oil prices were to stick around, the problem with that is obviously it's going to act as somewhat more of a tax on the consumer. In the United States economy, it's 70% is consumer spending. So if you're spending more at the pump, you obviously can't go make that discretionary purchase. So it would have an impact, probably slowing GDP. It's not going to necessarily break the economy by any means. If we're at $120. But you could start to see a slight impact on the growth side. And then I talked to this, but on the nearer term inflation expectations as well,
Yeah.
which I think can somewhat flow into interest rates.
Yeah, and I think originally, when all this was happening, Iran, 90% of Iran's oil goes to China, and that's only 12% of China's overall oil usage. So originally, it was a very small part of the market. Well, closing of the passage is the main thing because they currently about 6 ships make it out a day. They're saying 3 to 6 ships a day. That's coming down from about 135 to 140 ships daily that we're making out. There's over 1,200 ships sitting in the bay waiting to potentially get out, which obviously is a huge supply shock to the market right now, which will continue to fluctuate oil prices because sometimes good news is bad news is good news. And as this all develops and as a solution potentially to help get ships out is made, we're kind of just at the mercy of oil prices until then. I mean, the market hates uncertainty, and obviously, right now there's quite a bit of uncertainty of how we're going to come to a resolution on this. So as the data comes out, we have a feeling, potentially those December future prices could be reality and hopefully lower. But we'll go. Do you want to do U.S. debt levels? Please comment on U.S. debt levels uh, and the impact on U.S. Treasury bills. I know that yields have come up, but that's more geopolitical currently. We still feel debt levels are high and continuing to grow. I think, the bond market will be the regulator, the end all be all. If the hawks come in and they decide that rates need to go up so that we can have different, I don't know, views as to the debt levels. But we think, and obviously our economic forums we've had over the last few years have focused on this, which uh, cheap ploy, I guess you can go to our websites and watch those as well. But debt levels are a concern, and if we can continue to grow the economy at a higher rate than our debt, interest rates, it could be beneficial. Inflation's also a key to that, but we're monitoring and we're hoping that, or I think, in the end, cooler heads will prevail and potentially we'll see changes in that market. You got anything, Christian, if you want to add on rates specifically?
No, I think it's, I mean, there's a couple more in here too. We can, um, let's see the latest one. Any thoughts on the new Fed chair?
Oh,
So
yes.
the new nominee, he hasn't been confirmed yet, but I mean, the most important thing, which is interesting, we actually wrote a piece on this, I think in 3Q last year. I wrote a
Yeah.
piece on this. The most important thing is Fed independence,
Yep.
re remaining, yeah, keeping the independence. So, but Kevin Warsh, the history, I would say, of Kevin Warsh is he's actually been more hawkish over the last few years, or, kind of even during the Great Financial Crisis. But as far as like, it's still a committee. We do think, I think the market reacted positively when he was nominated, because I think, we will continue to see Fed independence, which again is the most important thing. But we also think he's not going to, bend over and, move interest rates just because maybe somebody, the president says so.
Yeah, I agree. I think the independence, we want the independence to stay, and it is a committee. So more voices are in the room. So we think that that's a good thing. I am not seeing anything else. Well, we really appreciate everyone's time. Again, please reach out if you have questions or something comes up later. Let us know um, how we did. I mean, even if that's what the email is. But thank you very much. Hope to see you at our next client event and have a great day.
Thank you.